The market commentary for Friday, the 2nd of August 2019, and incorporating a little bit of crypto action over the weekend of the 3rd and the 4th. So a new month is upon us. First of all, my apologies for no commentary on Thursday, and somewhat of an abbreviated version for today. Normal service will resume on Monday. That's for Friday. Well, it was the day still trying to recover from the previous 2 days volatility, courtesy of both the Fed and President Trump's decision to increase tariffs on Chinese goods. For crypto, these events had meant reasonably quiet markets and focus obviously on other markets such as currencies, obviously, as well as equities and fixed income. But Friday and the weekend, we'll see a bit of a push higher, led by Bitcoin. Got up to around about 10,500 on Friday, and then follow through up to the 11,000 level over the weekend. ETH would also edge higher, going up to a high of around 223. No great catalyst behind it. I think crypto resilience has been tested once more, and for now at least, it appears to be coming back fairly strong. I guess the lack of follow through from the drop we had the weekend just gone would suggest that there are buyers lurking on a dip, and maybe a few people getting a little bit overly bearish, trying to push the market lower and failing, maybe having to cover. So it'll be an interesting week ahead to see if the crypto market can build on the gains we've seen over the last couple of sessions. For FX, dollar strength really has been the theme since the Fed rate cut on Wednesday, and obviously we've had Mr. Trump's comments as well. The main exceptions to that would be dollar yen, which has borne the brunt of much of the risk-off yen cross-selling. Friday was really all about the US non-farm payroll data, which is often a day where we get excessive volatility and the market gets very excited. But I think it's fair to say for the week just gone, it actually sort of played second fiddle. The headline number actually came in exactly as the market had expected, which almost never happens, at around 164,000 jobs created, and the unemployment rate remained steady at 3.7%. So in light of everything else that's been going on, not a whole lot for the market to get hold of, under the fuel concern that such relatively strong data would only back up the argument that the Fed could well be one and done. With that in mind, equities suffered a third day of fairly heavy losses, with the Dow Jones down about 100 points, or just shy of 0.4%, and the Nasdaq lower by 1.3%. Gold continued to benefit from lower equities and lower US interest rates, heading up to 1450, and the 10-year US yield has now fallen to 185. I think before the last time we spoke, it was around 205. So it's a fairly significant move, even in a couple of days. For currencies, euro has returned to the 111. I'll say that one more time. Euro has returned to the 111 level, having dropped as low as 110.30, and sterling sits around 121.50, marginally off its lows last week at 120.85. Aussie finally broke the 68.30 level and ended the week at 67.90. Dollar yen, as mentioned, has come under a lot of pressure. Ended the week at 106.60. It was probably around 109.30 when just after the Fed rate announcement on Wednesday afternoon at US time. So the week ahead is it's going to be an interesting one. A lot of eyes are going to be on developments between the US and China. Traders will also keep a close eye on equities to see whether this is just a blip on the radar of the sell-off, or the beginning of an extended sell-off following what has been a fairly exhaustive rally since the beginning of the year. So it will be interesting, but I think it will really depend on what happens between the US and China. If we get a breakthrough there, then one would imagine that equities will probably rally fairly strongly on the back of that, and I would expect dollar yen to recover a bit as well. So from a technical standpoint, dollar yen is actually what I'm going to take a quick look at. Dollar yen often gets caught up in the crossfire of yen cross trades, and as such, best reflects the effect of risk on and risk off trades for the crosses. I think I mentioned before, things like Aussie yen, Kiwi yen, CAD yen, and sterling yen can often be currency trades which investors will put on to reflect the current economic environment, especially when stocks are having some fairly strong moves in one direction or another. As you can see from this chart, the moves at the end of last week, we were up at 109.30-ish and ended up down to, I think the actual low was about 106.45. That was a very sharp, very sharp move to end the week. As you can see from there, we broke initial support there, June's low, or early July low, actually, I guess that is. Sorry, end of June. 106.78, and if you go just a little bit deeper here, going back to right at the very beginning of the year, this is something we've seen in a couple of different charts I've shown, going back a bit on the 2nd of Jan when we had what is affectionately known as the flash crash. We went down to a low of around 104.92. Technically speaking, there will be support, but just keep in mind this was a move which lasted a matter of minutes, so it may not prompt the most as much support as maybe some of the other levels we look at. If we are to get a bit more of an extended sell-off in global stocks, the US and China don't resolve their issues on the trade front, look for this level to get tested, and even below, dollar yen will, you would imagine will probably suffer. Conversely, if everything works out, we get a trade agreement between the two of them, then back up we come. So keep an eye on it. And that's really it for me for the weekend. So I wish you all the very best of luck for the week ahead, and look forward to speaking to you tomorrow. Cheers.